Hello and welcome to Gold and Silver Assets. I'm Diora and it's Sunday the 25th of July 2021. We've been hearing a lot lately about how inflation is just transitory. So I thought we'd take a closer look at that today. We know that the word transitory means temporary, fleeting, not permanent, but that's all a bit vague. Transitory over what timescale? Days, months, years, decades? Even if the timescale is defined, we also need to know the magnitude of the transitory move. Also, is it just a one-off, or will it occur repeatedly, and if so, how often? Inflation can be categorized into four groups in terms of magnitude. And these cutoff values I've shown here are actually quite arbitrary, but according to official numbers, we're currently in walking inflation. And I think the word transitory has been used to infer that inflation will soon settle back to the creeping level. This chart shows the consumer price index from 1800 to 2005. In black is the cumulative amount, and in red is in the bottom there is the annual change in inflation. So that's basically the official inflation rate that is usually quoted to us. Now there's lots of interesting things to see in this chart. Back when gold and silver were directly convertible with the currency, then we can see that the cumulative price here was actually relatively flat. It just kind of oscillated within this narrow range here. These two spikes here, there we go, here and here, actually coincided with wars. And at the time, because of the costs of those wars, the inflation rates were actually very high, kind of getting around 20% over there. Those spikes were then followed by deflationary episodes. You can see that inflation rate dips below zero after that. And here it dipped quite deeply below zero. And as a result, the consumer prices settled back and basically went back down towards that stable level there. So what was happening is that inflation was being counteracted by deflation, keeping those consumer prices within a narrow range. And what we're seeing here is a high degree of oscillation above and below zero. So around half the time was spent above zero and half the time below zero. So what we can say is that gold convertibility acted like a kind of corrective mechanism against excessive extravagance. When we got to the gold standard, that started to slip. We can see here that inflation occurred 4 times as often as deflation. And so as a result, you can see that the cumulative prices started to lift off from that narrow range. In the fiat era, there hasn't been any deflation to speak of, and pretty much the whole time has been spent in inflation. And what we can see, the result of this is that the consumer prices just keep rising on a cumulative basis here. Basically, that whole compensatory mechanism that we had here no longer exists. A 2% inflation rate doesn't sound too bad, does it? But most forget that it's cumulative. It adds up over time, and it can make a huge difference over decades. Even if we had a massive deflationary event, let's say we had an inflation rate of -10, which occurred back here in the 20s and 30s, I don't think that's going to make a dent in what's already happened here. We're not going to be able to reverse this and go back down to here. No way. That just seems very, very unlikely. For the everyday person in the fiat era, what this means is that the cost of living has consistently increased, and that's something that has not been and is unlikely to be transitory. The only variable is the rate of that increase. Zooming in a bit closer, this chart shows the cumulative CPI in black, and I've drawn a trend line in red, which goes back to the early 70s. What you'll notice is that consumer prices have not dipped below that line in over 50 years. And personally, I think it's very unlikely to do so. We can see this dip here in 2008, but that looks pretty tiny, doesn't it? Going forwards, at most, I would expect a dip to this line. But the other possibility to watch out for is a change in the slope of this line getting steeper. That's what we really don't want to see. That happened over here quite dramatically. It is entirely possible to get an even steeper line upwards. This is a chart of the annual rate of inflation from 1950 to present. We can see that from 1955 to 1980, this has been in an uptrend like this, with higher highs and higher lows. But we also must note that it didn't go up in a straight line. So steep rises in inflation were followed by steep drops, so bouts of disinflation. And we can see that the steeper the rise, the steeper the drop. Since 1980, this has been in a downtrend like this. And so we've had lower highs and lower lows, particularly over here. Now, interestingly, since 2010, it kind of looks like we've got this triangle that formed here, and this broke out recently to the upside. Since 2010, you'll also note that we've had higher lows in the annual rate of inflation. The question is, are we going to start getting higher highs? I mean, we're getting pretty close to this one here. If we surpass that, of course, yes, it's going to dip down a bit before it makes another move up. And yeah, are we going to get above this 1990 level? That's something that's going to be worth watching out for. So rather than looking at, you know, the zigzags, you want to look at what the overall trend is doing. Here's an interesting chart. This shows volatility in annual inflation since 1800. The inflation rate was most volatile in the 1860s, the 1920s, and the 1970s. Over time, we can see that in general, volatility in inflation rate has gradually reduced. So that's in a downtrend. And it actually reached historic lows here in the early 2000s. The other thing to note from this chart is that it kind of appears to be cyclical. So you've got these kind of curves here. Of course, the cycle length is very variable, so I don't think the cycle length tells us that much. But what we're seeing here is that once you've got a trough, then the volatility does tend to increase after that and spike up. And right now, we just seem to be kind of at the bottom of one of those troughs. So, are we going to get a spike in volatility of inflation? Who knows? How volatile is inflation during a crack-up boom? We're all used to seeing this chart, which shows the German CPI on a log scale during the hyperinflation of the early 1900s. This gives the impression of a constant rise in CPI, which is actually correct. But as we saw earlier, this is the cumulative chart. It's not what's quoted in the official figures. So I'd really like to see what the annual inflation rate was at the time. I did do a bit of digging, but this is the only chart of annual inflation in Weimar that I could find. And so it only covers 1919 to early 1923. And so it doesn't actually include kind of the bulk of the kind of last stage of the hyperinflation. But what it does show is the ups and downs, or where you get inflation with bouts of disinflation in between. As hyperinflation progresses, stock market volatility also increases quite dramatically. So the top chart here shows the general stock market during the crack-up boom. And so in blue, it's priced in the paper marks. And in green and red, it's the stock index adjusted for inflation or for US dollars. So in real terms, as shown by these, we can see that the stock market performance was so-so really. And even then, it also had its ups and downs. You can see a kind of significant dip here, even though in paper terms it was going up. The lower chart here shows an estimation of what the VIX would have been at the time. At the peak of the hyperinflation here, the volatility was a whopping 2,000%. This chart shows the annual inflation rate in Venezuela from 2017 to 2018. This illustrates how volatility increases. Now, although we can see that the annual inflation rate is in an uptrend, we can also see that it doesn't go up in a straight line. So rises like this are followed by bouts of disinflation. Here we had a large rise, and then there was a large area of disinflation there. Here it went from 40,000% to 20,000%. On this chart, the area in red shows the same time period as we saw in the last chart. And the bars over here, so that's this thing here, represents the stock index. And of course, they clearly skyrocketed, as you'd expect. But what most people don't realise is that the volatility is quite significant over that time as well. The grey lines here show the stock market returns, which over here swing from 40% profit down to a 20% loss here. And so again, we can see how stock volatility increases as hyperinflation progresses. So here you can see a much bigger range in those returns compared to around here where they move within a kind of flat range. So a significant drop in the stock market does not exclude the possibility that a crack-up boom is in progress. The same is true of the gold price. In black is the price of gold in paper marks in Germany, and the red line is the monthly percentage change in the gold price. Again, we can see huge volatility in that. So most months had a high percentage return, particularly over here. You can see around 150% return that month. That's massive, isn't it? But also you can see that losses also occurred, and so you can get over 20% losses over here as well. Putting together a few thoughts from what we've learnt in the last few shows, we know that deflation can be observed in good economies and in bad economies. The same is true for inflation. I reckon what we're currently experiencing is inflation in a bad economy. I also think that these inflation terms are actually quite vague. You can have two people talking about the same thing but mean different things. And so that kind of leads to debate. What I really want to know, and I think you'll all be in the same boat here, is will our cost of living rise, and what will happen to the price of the assets that we hold? As we saw last week, it's entirely possible for these two to move in opposite directions. So in the example we looked at last week in Japan, it's possible for consumer prices to rise while asset prices can dump significantly. So what do I think will happen? Well, with consumer prices, based on the cumulative CPI charts and personal experience, I guess, I think that there's a fair chance that we're going to get this. Basically, I think the cost of living will just keep rising. As far as assets are concerned, now I don't have a crystal ball, so I don't know for sure, but I can give you a guess, which could be completely wrong. But the other thing to remember is that things can change. And so this is a dynamic thing. This is my view right now. But obviously, if something changes out there, then we've got to be flexible and we've got to be able to be agile in terms of our views. For example, if a bunch of libertarians suddenly came in and took over management of the financial system, then yeah, I would change the direction of where I think things are going. So this is just what I think as things stand now, and I've kind of based it on multiple factors and looking at things from different angles. So what I'm thinking is that the price of most assets in the next 6 to 9 months will go like this. And I think there's going to be a significant amount of euphoria. We haven't really had a really good solid blow off top yet, but I think that's coming. But having said that, euphorias, we know how they all end. And so I think that's going to be followed by the risk of a massive drop in the price of most assets. And I think that's probably going to happen around the second quarter of 2022. Again, I'm not great at timing, so I could be completely wrong on that. So that's just a guesstimate there. But I think that drop is going to catch a lot of people out. And I think it's going to last, again, about 6 to 9 months. But for those who are able to manage this kind of massive volatility, there'll be a reward at the end as well, because I think that asset prices are going to move up big time, especially gold and commodities. But yeah, even gold is going to get caught out with this. And the other thing to say is that, you know, a lot of people are rooting for gold and, you know, talking about $10,000 gold and so on. I think we're still a way off from that. I think prices will rise up here, but, you know, I don't want you to think that I'm pumping gold as this goes up. I don't think gold is going to be the best performing asset during this rise. There are going to be other assets that outperform gold. And this drop is going to be a tough one to deal with as well. But we'll talk about all of that as we go along. So in conclusion, inflation is transitory, but I put the star there to signify that conditions apply. You've got to read the small print. It depends on how you define transitory. On an annual basis, the figure will zigzag up and down. So even during a hyperinflation, the annual rate of inflation cools off intermittently. And so even then you could say inflation is transitory. However, on a cumulative basis, the cost of living has been continually increasing for decades. There's nothing transitory about that. As inflation increases, we can expect to see increased volatility in both the rate of inflation and the stock markets. That means that the rise will be punctuated by bouts of disinflation. As far as the stock market is concerned, that suggests that in the right hands, active management may well outperform passive management. Next up, the market update. Let's start with gold priced in US dollars on the monthly scale. And I think I ought to say those three words. Those three words that are difficult to say, but you want to hear it. I'm still bullish. Okay, so on the monthly scale, this doesn't look too bad. I know there's lots of people freaking out, a lot of people fed up about gold and the gold price and particularly the silver price. But if you just zoom out and look at the big picture, this actually doesn't look too bad. I can't really see any breakdowns in what our original thoughts were. We had this worrying red candle here, which basically reversed that whole green candle. So that was a bit worrying. But the great news is, look, I know the month isn't over. We've still got a week to go. But so far, as long as this candle remains green, that's great news. You'd be much more worried if you had a red candle, which suggests that this down move was showing some follow through on the monthly scale. And we haven't had that. But look, I know it's a little bit too early because that candle hasn't finished yet. But there are a few other reasons why I'm feeling still positive. Of course, in the longest timescales, this is an uptrend. There's no denying that. We've got higher highs and higher lows still. And this to me still looks like a correction within a larger uptrend. So we've got that. And of course, whenever you're thinking about the gold price, you've got to determine which timescale you are thinking about. Obviously, if you're a day trader, then this isn't going to be relevant to you at all. So let's have a look at gold. So this is that previous gold chart, but this is that overlay of the parabolic line fits that I talked about in previous shows. And so the orange ones are for the highs, and the fit is not great for that, but it's okay. But it's really the lows that we're interested here. Now I've done a kind of rough overlay. It's not perfect because I haven't been able to work out how to get these lines onto TradingView. I know the equation of the line, I just don't know how to program it onto TradingView. But that line has a great fit at the moment. It's 0.9948. So a perfect fit is 1, so that's actually pretty good. You'll also note that the previous fit was slightly less. So when we didn't have this data point over here, then it was 0.98. And that predicted the low within about $16 of the actual low. So that was pretty good. And now that we've got a much better fit, what we want to do is see if this breaks still. At the moment, you can see the price is here, so it's still within that arc there that we've drawn there. And remember that this hasn't been drawn subjectively. This is the computer has drawn this, not me. And so that's what I like about it. Okay, so the next question is, where are we in terms of time, and what are the kind of limits that we're looking at? Now remember, because it's not a perfect fit, you can dip slightly below it, but not greatly below it. I mean, if the next price, in the next month or so went down to 1600, well, that throws this off, and you'd end up with an actual worse fit than this. So what we're looking for is something pretty close to where this is. So in the end, I had to actually work this out manually. So it took a bit of time, but I've worked it out in terms of week by week, what's the low price that we're looking for. And here it is. So the low of this week, we didn't want it to break below 1777, and it hasn't so far. So that's good. Next week, we're looking for a low of about 1782, and obviously as time goes by that number goes higher and higher. So really we're looking for a maximum price drop of to around 1780, let's say. Remember, this isn't 100% perfect, but what we're not looking for is a dramatic kind of plummet below that level. Okay, so again, we can still say that this is within that bullish case, but not only that, it's still within the potential to have a parabolic move. And let's zoom in a bit closer. So this is gold in US dollars on the daily scale. And last week we were talking about this rising wedge shape pattern here. And I said that if price broke below 1800, then we can expect lower prices. And that's what we got, basically. We're about halfway down towards our target. Now, looking at this, it's interesting because remember we were talking about 1780 on that parabolic kind of curve. Well, if you look over here, there seems to be a fair amount of support at that level as well. Probably worst case scenario is a drop to about 1750 or 60, but I'm not expecting to break this low. This line here is actually the joining the lows for the past few years, actually. And so that would be our absolute kind of line in the sand where we'd just say, oh no, this is going down much, much further. But yeah, I don't know. I think 1780 is probably about as low as it will go. The other thing to remember is when we were talking last week about the US dollar index, and I said that we just had a little bit more potential upside, but not much. And then I think the dollar index is going to drop. And so that would again fit with this scenario here that we're talking about. The other thing that I was looking at, and a few months ago, I don't know if you remember, but we were talking about the correlation between gold and silver. And whenever it goes negative, that suggests we're kind of close to a local bottom. So we saw lots of examples of where that had happened previously. And what we noticed, so the last time this happened, we actually tried to look at it prospectively. And what happened was this correlation went negative, then it turned positive, but there was a little bit of a lag before the bottom actually occurred. But of course, last time it went much deeper than this. This isn't too deep, but the good news is that you can see that that we've got this kind of angle here. Now, of course, that can change and it can go even deeper negative. So it's just something we have to watch. But once that goes positive, then that suggests we're getting close towards the bottom. So we're not there yet. This basically tells me we're not at the bottom for gold yet. Let's just keep an eye on that. Okay, moving on to silver priced in US dollars on the daily scale. And as I mentioned, I think silver is a lot less reliable when it comes to trend lines and things. It just tends to mess people around. And so I did say that if this breaks, I still wouldn't freak out because it's the gold that we really want to look for in terms of whether we're bullish or not. So yeah, this broke and that would have upset a lot of people. But one of the things is that we've got another one of these falling wedges, which we had last time. And if we look back here, there's a fair amount of support between around 24 to 24.5 kind of area over here. And so that would kind of fit with, I think we've got more downside with silver, okay, but I don't think it's going to be dramatic. So I think we've got another dip down to hit this trend line again, potentially. Probably, I'm guessing around 24. It just depends how long it spends up here. I mean, if it takes a bit longer, then obviously that'll be lower. But I'm thinking it's going to do the same thing that it did over here and bounce back up. Now, when it gets to this trend line here, it will probably hit a little bit of an issue before continuing upwards there. But that's the trajectory I'm thinking of. I think this is a fourth breakout from a much larger ascending triangle that we've got here. But yeah, let's wait and see. I know that there are some people who are talking about this breakout being a true breakout, and it could well be. But then we'd be looking at, you know, prices coming down to about $20. That's not impossible, but I'm going to go on the bullish side. Okay, and then we'll move on to the GDX on the daily scale. And yeah, the miners have suffered a lot, haven't they? Looking at this, what I've done is I've looked at the move from March last year to the peak over here, and looking at the Fibonacci retracements, we already had around a 50% retracement here. Notice also that we broke out from this descending trend line. So we started an uptrend, but that kind of petered out here and got smashed down. And so I reckon it might well retest that trend line, but what we don't want to see is a lower low. So we don't want to see a break of this, because that would basically suggest that there's going to be even more downside. But remember that there was quite a lot of support there if you go and look on the monthly scale chart. So I think that's going to hold still. The other thing that we can see here is that we've got this kind of broadening pattern that's been forming here. And I think that is going to break down. I think, as with the metals, we're going to have another move lower. But I think it's going to be stopped here, maybe around 32, let's say, before we get the turnaround. Okay, and then we'll look at the silver miners. Yeah, so the silver really suffered. Silver miners did. Oh dear. You'll notice that throughout this whole consolidation time here, we only got to the 38.2 retracement, well, just below that. So we haven't actually hit that 50% like the gold miners did. And as I said last week, I do think there's more downside because there's just not much support in this area. Most of the support seems to be around the 12 region here. And also that would fit with that 50% retracement. The other thing is that we seem to have possibly a little triangle here. So it's a kind of upside down flag. So again, a similar kind of length move would fit with that 12 target before we move up. So yeah, it's not ideal news, but look, the thing is, when it does move up, I know the down moves for both silver and gold can be harsh. And the thing with this space is the volatility. Volatility can be an absolute killer, and that's why leverage in particular can really be a killer. And the thing is, with these things, you've got to almost expect to have a 50% drop in your portfolio. So, you know, that's actually pretty normal. But on the flip side, you know, this can go up 5x from here. And so, you know, it's just a kind of matter of riding it out, really. Anyway, I'll talk a bit more about that kind of thing in next week's show, but don't think that a 50, 60, even 70% drop in your holdings is abnormal in this industry. It's not abnormal at all. Okay, and we'll finish off with another little anecdote from real life. So I was talking to a friend in the UK, and he wasn't keen to travel abroad at the moment with all the palaver going on. And so he decided he'd have a staycation. And so he was phoning around hotels and things. And there was one nice boutique kind of hotel. It was quite a fancy place. And he thought, yeah, I'd like to stay there. So he phoned them up. And yeah, they said, yeah, they've got some availability, but they're pretty busy. And the only catch is that you have to clean your own room. they don't have any cleaners. They just can't get anyone to do the job. And not only that, the price for the room is also higher than normal as well. I hadn't heard anything like that before. That's very unusual. Anyway, everything's really strange, isn't it? Right, that's it from me. We shall see you next week. Until then, bye.